Brad Williams, Frugal Finance, tips for online investing, what you need to know about trading in fast-moving markets. What you need to know about trading in fast-moving markets: the price of stocks, especially recent hot IPOs and high-tech stocks, can soar and drop suddenly in these fast markets. When many investors and prices change quickly, delays can develop across the board. Execution and confirmation slow down, while reports of price lag behind actual prices. In these markets, investors can suffer unexpected losses very quickly. Investors trading over the internet or online, who are used to instant access to their accounts and near instantaneous execution of their trades, especially need to understand how they can protect themselves in fast-moving markets. You can limit your losses in fast-moving markets if you know what you're buying and the risks of your investment, and know how trading changes during fast markets, and take additional steps to guard against the typical problems investors face in these markets. Online trading is quick and easy. Online investing takes time. With a click of a mouse, you can buy and sell stocks from more than 100 online brokers offering executions as price as zero. Although online trading saves investors time and money, it does not take the homework out of making investment decisions. You may be able to make a trade in nanoseconds, but making wise investment decisions takes time. Before you trade, know why you're buying or selling and the risk of your investment. Set your price limits on fast-moving stocks, market order versus limit order. To avoid buying or selling stock at a price higher or lower than you wanted, you need to place a limit order rather than a market order. A limit order is an order to buy or sell securities at a specific price. A buy limit order can only be executed at the limit price or lower, and a sell limit order can only be executed at the limit price or higher. When you place a market order, you can't control the price at which your order will be filled. For example, if you want to buy the stock of a hot IPO that was initially offered at $9 but don't want to end up paying more than $20 for the stock, you can place a limit order to buy the stock at any price up to $20. By entering a limit order rather than a market order, you will not be caught buying the stock at $90 and then suffering immediate losses as the stock drops later in the day or the weeks ahead. Remember that your limit order may never be executed because the market price may quickly surpass your limit before your order can be filled. But by using a limit order, you can protect yourself from buying the stock at too high a price. Online trading is not always instantaneous. Investors may find that technological choke points can slow or prevent their orders from reaching an online firm. For example, problems can occur when an investor's modem, computer, or internet service provider is slow or faulty. A broker-dealer has inadequate hardware, or its internet service provider is slow or delayed, or traffic on the internet is heavy, slowing down overall usage. A capacity problem or limitation at any of these choke points can cause a delay or failure in investors' attempt to access an online firm's automated trading system. Know your options for placing a trade if you're unable to access your account online. Most online trading firms offer alternatives for placing trades. These alternatives may include touch-tone telephone trades, faxing your order, or doing it the low-tech way, talking to a broker over the phone. Make sure you know whether using these different options may increase your cost. And remember, if you experience delays getting online, you may experience similar delays when you turn to one of these alternatives. If you place an order, don't assume it didn't go through. Some investors have mistakenly assumed that their orders have not been executed and place another order. They end up either owning twice as many shares as they could afford or wanted, or will sell orders selling stock they did not own. Talk with your firm about how you should handle a situation where you're unsure if your original order was executed. If you cancel an order, make sure the cancellation worked before placing another trade. When you cancel an order online, it is important to make sure your original transaction was not executed. Although you may receive an electronic receipt for the cancellation, don't assume that means the trade was canceled. Orders can only be canceled if they've not been executed. Ask your firm about how you should check to see if a cancellation order actually worked. If you purchase a security in a cash account, you must pay for it before you sell it. In a cash account, you must pay for the purchase of a stock before you sell it. If you buy and sell a stock before paying for it, you are free-riding, which violates the credit extension provision of the Federal Reserve Board. If you free-ride, your broker must freeze your account for 90 days. You can still trade during the freeze, but you must fully pay for any purchases on the date you trade while the freeze is in effect. You can avoid the freeze if you fully pay for stock within 5 days from the date of the purchase with funds that do not come from the sale of the stock. You can always ask your broker for an extension or waiver, but you may not get it. If you trade on margin, your broker can sell your securities without giving you a margin call. Now is the time to reread your margin agreement and pay attention to the fine print. If your account has fallen below the firm's maintenance margin requirements, your broker has the legal right to sell your securities at any time without consulting you first. Some investors have been rudely surprised that margin calls are a courtesy, not a requirement. Brokers are not required to make margin calls to their customers. Even when your broker offers you time to put more cash or securities into your account to meet a margin call, the broker can act without waiting for you to meet the call. In a rapidly declining market, your broker could sell your entire margin account at a substantial loss to you because the securities in the account have declined in value. No regulations require a trade to be executed within a certain time. There are no Securities and Exchange Commission regulations that require a trade to be executed within a set period of time. But if a firm advertises their speed of execution, they must not exaggerate or fail to tell investors about the possibility of significant delays. If you have any questions or comments about trading in fast-moving markets, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.